Hello friends, welcome back to the channel, best place for long-term stock investors. It's been a 1 week hiatus, right John? So thanks for waiting for us to come back.
Yep.
Now today we're going to talk about Cypark resources, and Cypark is down, I believe 60% year to date. So we're going to be talking about why all of this has happened. We're going to look through, brief through what they do, what is the financials, maybe a little bit about management, and maybe some of the outlook for Cypark. Now, as a disclaimer, we do not own any shares in Cypark.
So if 2022 should be a year for you to be your own fund manager, I hope that is a question when you are a viewer of this YouTube channel. Fret not, MJ and I, we will be sharing with you whether you should be your own fund manager on the 16th of June. And that event, for you to register, you can find those links in the comment section below. And I look forward to seeing you then.
Okay, John. So Cypark, right? It's down, as I said earlier on. So if you look at the 5-year chart here, it's down basically 50% over since 2010, so 12
I think
years.
at the peak was 152 in most recent times.
Yeah, exactly. So that's a big dump essentially. And so sometimes, what we're going to do here is something a little bit different. We're going to see how we can assess, potentially new ideas, right? Now, we didn't do much research on Cypark on purpose so that we can show you how we would go about analyzing a stock that is down a lot, that is potentially an idea.
Yeah.
Right?
Actually, what normally happens is that it becomes headline news because of the price, and we would showcase to you in a way. Let's just say something like this happens. What would be our steps or methods on how to assess? Is this an opportunity? Is this is this something that we can learn to build it as a mental model?
Correct.
That we can avoid these kind of companies if this is a disaster, in the future.
Yeah,
right?
Exactly.
So where will we go first, MJ?
So usually you want to learn about what the company does. It's very basic. There are two options.
Okay.
One, you can go to their website.
Okay. So let's say Cypark website. Or we just put Cypark.
Yes. Or you can go to your annual report. But let's start with the website. Usually they have nicer pictures there.
Yeah. So is this Cypark resources?
Yes, this is the one.
This is the one. Whoop. Oh, that's interesting.
Huh.
Okay. So if they're upgrading their website, then...
Oh, there you go.
Oh, there you go.
Interesting. Okay. So usually most websites will really tell you, right, what they do. If they're good, they'll send you pictures. If they're very good, they'll send you better pictures.
Yeah.
Right? So you can see they are in the renewable space. So if you go up, right, so you can, if you go to like services. So you can see, right, at a glance. Right, they're in green technology. So this really gives you a sense of what they're doing and what kind of industry they're in. Are they in a uptrend industry, a downtrend industry, or flat industry? And so just with this information, you know that they are in an industry that is on the up. Now, this doesn't mean that the company is good. Doesn't mean that it's a good investment. It just means that they are in quote unquote the right industry.
Yeah, they also gave some sort of a historical milestone of projects they've executed. So good in a way. You're trying to access their track record. So there's many ways we can spin this from here. It's either let's just say they delivered this 29 million megawatt renewable. Where's this Kuala Sawah, right? You can go and Google it, try to find pictures whether it was a good project or not, and you can make assessments on their track record, right? So what next? In a way, I always like to go to this thing called investor relations, because that's where you can find what they have presented to the public. And sometimes if you're lucky, and I'm saying this in a Malaysian context, you actually get probably investor decks. In a way, like a PowerPoint presentation to give you either their latest company updates, or even, if you're even more luckier, they give you an industry background of what kind of industry they're in. You mentioned earlier about whether they're in uptrend or not. That will probably be, if it's an industry report, that will probably give you like, okay, right now we're growing at a certain percentage or whatever. That'll be good. Right?
Yeah.
So okay, all this corporate governance. Okay, so what next? Is it financial information, or do you?
Yes.
Is there a better way?
So again, if you guys want a more HD version of what they do, look at the annual report. Usually, not only do they give you, what the company does, but what's happening in that year.
Correct.
There's a lot more information there. Now, let's go to the financials and see whether or not they're decent. Now, so it's not okay. It's working.
Yeah, it's working. Okay, so this is an extract. Not bad.
So this is usually they'll compare it between a year or between corresponding quarters. But what we like to do is to use this app called Ticker, right? So Ticker is where the juice is at.
Yeah.
And so if you guys want to, sign up, I think we have a link in the description and the comments.
Yes.
To sign up. Okay, so you go click on Cypark. So we click on it.
By the way, Ticker is not just Malaysian data, financial data. It's actually global financial data, and it's really, really fun. We really like to use it. Yep. So it shows you the price chart, but what we really want to go to is detailed financials. Right. And you can actually drag to see. They actually, when did they list?
20, if I'm not mistaken, 2010. But then they can go back all the way to 05.
Usually, this one, they take 3 years of financial history from prospectus.
Correct.
They probably listed in 05, 06, 07. Probably listed in 07.
Yep.
Yeah.
But the price on Google only goes back until 2010, interestingly. So anyway.
So you've got full financial history here. Best part, you can copy the whole thing and play around with it in Excel. So let's just quickly run through the numbers.
So if you look at let's start with the basic ones, right? Right, profit. So let's take a look at what they're doing. So wait, this is
revenue.
So this is sales. Now, sales is interesting because it tells you like how many opportunities they're getting. So you can see that from 05 to maybe about 19, it was pretty decent. But right now it's in a bit of a blip. Right. So the question is, can it go up some more, or it's going to stay flat? So the last time they had a blip was in 2010, and they managed a pretty good comeback, right? They doubled their revenues from 2010 to 2019.
Yeah, so
that's really good.
Yeah, best feature about Ticker, it can plot graphs for you. I mean, I really love this feature.
Correct.
Next is, let's say, net income.
So you can see net income, it has been generally profitable, but just like the revenue, since about, let's call it 2018 onwards, it's been on the downtrend, a little bit flattish to use analyst speak. But of course, income statement is only one aspect of investing. You also want to look at the cash flow statement, right? You want to see whether the profits are real or not.
Ooh.
Okay, so again, this doesn't necessarily mean it's a bad thing, right? So if you can see,
let me take out the revenue one first. Then this can get bigger. And
okay.
I'm gonna drag this. So more recent years,
just 2010 onwards. I think.
Okay. Here.
So you can see here, right? The black, which is net income, generally paints a more positive picture. But when you look under the hood, when it comes to operating cash flow, apart from 2013 and 2015. They're more or less flat or down, right? So you can see the picture is slightly different. Now, does this mean it's a bad thing? I'll get your thoughts after this, John. But to me, you have to investigate more. Why is it that the operating cash flow is not doing well? And I believe part of it is just the nature of the industry. It's a pretty cyclical, lumpy industry when it comes to solar and renewables, right? That is very competitive. That's another key thing. But what do you think of this?
Let's look under the hood and see what has been the biggest chunk of. Okay, so you've got net income. Let's use the latest trailing 12 months. 76 million. Where is the chunk that you look at this accounts receivable? So that means they're billing their clients, but they're not collecting.
Yeah, that's
very, very common thing when we see negative operating cash flow. The other potential could be a lot of write-offs. The other potential reason why they have very, how would I say, negative operating cash flow is actually they depreciate a lot. But in this case, doesn't seem like it. based on what we've looked at their website, I think they are more of a project delivery kind of guy rather than the owner of the asset. I'm not sure. I'm not as we've demonstrated here. We have not gone deep, and we've done that on purpose. So it's, if you look at it, it's like completed projects, ongoing projects. So they're mainly, my guess is an EPCC contractor. That means they're contracted by their clients. They build the solar plants. And then they hand it over, and that's why you get very lumpy sales. But then you have to bill, and then if you're not collecting, then that's probably one of the
they're
reasons.
like project managers, like.
Yes.
So they have rendered their service.
Yes.
But they haven't collected.
Yeah.
Let's take a look at your balance sheet and see, whether or not. Let's take a look.
Yeah.
So if you look at their property, plant, and equipment.
PPE, net PPE.
So you see, that's very interesting, right?
Yeah.
So this is, again, we won't be able to address this in the video, but
Let me get
one thing you want to ask yourself is this. Typically, for property, plant, and equipment, they will maybe depreciate over 20, 30 years.
Correct.
Right? And so they have what? I think 2021, if you scroll down,
Yeah.
561 million, right? So if you do the math, let's say it's 30, right? So if you take 561 divided by 30,
30.
right? 561 divided by 30,
You should get.
you should get about nearly
18.
20 million, right? Not all will be 30, not all will be 20. But if you look at the depreciation, what is that number?
About 9.
So it's about half,
Yeah.
right? So either there's something more you have to discover about with this company, or it could be, and this is just my theory, all these solar assets are very long lasting.
Correct.
So there may be 50, 60 years instead of 30 years.
Yeah, and also you see it negated my earlier assumption that they are purely an EPCC delivery.
Yeah, exactly.
So right now it seems that they're very heavy on the balance sheet. That means some of these assets may be in their books. So this is how we go through. I mean, start with a blank piece of paper, and this is how we will look through a company. Obviously, this is just scratching the surface, looking at the numbers. But based on what we've shown you, there is a method to it.
Yes.
And once you've practiced it a few times, you realize that when you look at other companies in a similar nature or even different nature of business, right, you will discover that the numbers will tell you something.
Yeah.
And then you start digging, and then you find out, oh, okay, it doesn't match up here, or it match up here. Yeah.
So just from the numbers alone, to your point, right, you can already see what there are certain things you can infer from this, right?
Yes.
One, it's in a pretty lumpy industry when it comes to cash collection. Two, cash collection is difficult as of late.
Yes.
Because I believe it was okay.
Let's look at the receivables. On average, it was.
So you can see, right, from change in accounts receivable. Yeah, so you can see, right, on average 2013 to 2016 was 2015 rather was okay.
Yeah, okay.
But then suddenly, ever since then, billing becomes a lot higher. So that already should tell you a little bit about the relationship that Cypark has with its client, who has who is in a bigger position of power. And I would say in this case, the clients are in a bigger position
of power.
So that's one thing you can infer. Then the third one is that they are asset heavy, as John said earlier on.
Look at that.
So you can see.
I mean, cumulative accounts receivable on average in circa 2010 is less than 200 million.
Yeah.
Average 200 million. And all of a sudden, 2019.
Yeah.
Oh, double.
Right.
And then pump.
Yeah.
Yeah.
So, of course, there's an additional thing you have to do, which is to analyze, because they have several different businesses that you have to look at. So if you can go to segments, right? Because not all segments will be the same. Some will be easier than others. But of course, you can see environmental engineering, which is probably the renewables, takes up, the biggest chunk, which is based on 2020
looking like about
figures.
on just an eyeball, probably about 90%, I guess, almost.
Correct.
80-90%.
That sounds about right.
Yeah, because elimination,
Yeah. So, so again, this is all insights for you to discover, right? Now, the last one will go will be ratios. Let's see what we have for the ratios part.
Yep.
Okay. So you can see now one thing we like to look at is return on capital. So that's the second line. So what I can gather from this is that the industry has become a lot more competitive.
Correct.
For every dollar you put into the company, last time you can get 20 cents back.
Yeah. Now
you get
like
4 cents back.
4 cents. It's,
Right.
It's a bit.
Yeah. But what do you think overall?
I think, you see, in any business, there are definitely cycles to it.
Yeah.
And in this case, what we're trying to see is that even in an up cycle or a down cycle, how is the company managing?
Yeah.
How are they either they are downsizing their manpower, are they downsizing their project contract sizes? Are they actually maintaining certain kind of pricing power in which you look at gross margins? Are they actually collecting? Are they actually even pivoting in this case?
Yep.
So in segments earlier, right, we looked at it and we saw that, they try to pivot from environmental engineering to this new segment. I don't know whether it's just a re-recognition of because look at the elimination, right?
Correct.
My guess is some of it was here, eliminate and then move it over here. That's my guess lah.
Yeah. So it's best to always look at the annual report.
Correct.
Right?
To see. Yeah. And then prior to this, construction and engineering wasn't there. So this is a new division in the business. They're trying to pivot, obviously. This was not there prior to 2019. And why is this related to ratios in which, if you look at it, while it's going down, right, is that a temporary suffering because they are trying to pivot into a new business? Correct. And what does it take? Because as a business, right, if you boil it down into the essence of it, is really assets and working capital. And when you have good assets and then you know how to manage your working capital very well, your ROIC is going to be very, very high.
Correct.
Yeah, but the struggle will be when you have these assets, but they're not being sweated one. They don't have any more value because of the pivoting of the business model or the industry. And that's where you get stuck with something like this. But this is our guess because we haven't dig deep into it.
Right. So I have one follow-up question, but before that, guys, if you're enjoying the video, remember to like, comment, subscribe as usual, share it with a friend that might enjoy this sort of content. Click on the notification bell so when new videos come out, you'll know it fresh. Now, John, so you mentioned about cycles, and I do believe they seem to hint, again, we have not done deep research, but they seem to hint based on the numbers and based on previous knowledge about the renewables is in a cyclical industry.
Correct.
So here's where analyzing numbers can be interesting. You might be thinking, well, the returns on capital today is like 5%, 4%, therefore it's bad. Now, it might be the case that it's bad. Or it could be the bottom, right, of their cycle.
That's right.
In your assessment, right, what do you think will be some of the pointers and signals for you to dig deeper, to discover, to say that, we are at the bottom of this renewable energy in the specific industry that they're in? Yeah,
one that I actually try to look at always is actually their capex.
Yep.
Because on average, if you look at their capital expenditure, there you go. You see, on average, they weren't spending much. I think peak 2012, 90 million, and on average it's like peanuts. It's like 1 million, 2 million, right? All of a sudden, in 2020 and 2021, capex blew up to about 100 million, 200 million. So I would dig deeper to say, hey, what are they doing spending this kind of money? And what is the kind of return that I would be getting if these assets actually materialize and generate value, you see? That's one. The other one I will be looking at is when we read the annual report, and we're not going to do it here because it's going to be a 2-hour, 3-hour video after that, right?
Of course.
Is that what are the signs that the management are telling me? Is that a good annual report in the chairman's statement or in the MD&A, right? They'll tell you, hey, business is tough, industry is consolidating, all these kind of hints, and they'll tell you, oh, we're fighting single-digit margins, or or that we have to pivot in this way because cost of raw materials is increasing and all that. I think what I'm trying to highlight here is that the numbers give you a hint where to look, but the numbers is not ultimately that's it. I think that's where we're trying to inculcate in our community, in our viewers, and especially so in our SIB program, because what we try to tell the investors who want to manage their own money is that you have to, in Malay we have this term berjinak-jinak. I don't know if you remember your Malay.
No, I don't think I've heard of this one before.
Yeah, Virginia. It's like you're trying to be friends with the company you're investing in. So why is that so? Meaning, if you're trying to befriend a person, right? What you try to do? You try to understand what he eats, how he spends,
correct.
his characters and all that. It's the same for that of a company.
Yep.
And the quickest way is using tools like Ticker, Morningstar and all that, and also reading up on the annual reports. In a way, your annual report, think of it is a love letter from your friend trying to tell you how is he doing the past year,
And he doesn't tell you much.
Yeah, doesn't tell you much.
Your friend,
Yeah, do you really want to be a friend with him?
Yeah. I only have one final thought is this, right? So, you mentioned capital expenditure. So if we can, if you scroll down, right, you can see they are roughly spending, so they spent 200 million over the past couple of years. So typically a good business needs to at least generate 10% right, in profits.
Yeah.
So, okay, so I'm going to do some quick math here, but here's what you should be expecting. So if you are spending, let's say, 200 million in latest quarter,
2021.
Correct.
Yeah.
So you want to hit 10% of, let's say, operating profits, right? So that means you need 20 million, right, in operating profits. So to get 20 million in operating profits, how much revenue do you need to make? So if we go back to the income statement.
Yep.
So let's go to operating income, right?
Operating income, here you go.
So operating income, the margins are 30%.
Yeah.
So that means, right, for you to get a 10% gain or returns on capital, spending 200 million on capex should, if it is possible, bring you about 50 to 60 million in additional revenues.
Yeah.
At least every year.
Yeah.
If it's hard for them to do that, then it's something for you to think about.
Is it really a good business for you to?
Yeah. And remember that is only on the basis of the property, plant, equipment,
correct,
which is the capex, right?
Correct.
Investor capital is not just that. We go really deep into this in our SIB program, but the gist is, investor capital is just the property, plant, equipment plus what we call working capital, which is what you mentioned earlier on.
Correct.
And if you add in the working capital, and we saw just now, receivables, that's part of working capital.
Correct.
You need to make way more than 60 million. If working capital is the same as property, plant, and equipment, which is probably not, you will actually need 120 million.
Correct.
In revenue.
Yeah.
But I suspect it's definitely less than that. But the basic point is you need a lot of revenue just by spending 200 million. And remember, they spend, if you scroll up to the chart, right? They spent 200 million not just in 2021, but also in
I think in 2020 they spent about 90 million.
They also spent about nearly 100 million on that.
Yeah.
So that's something you want to take note of, right? Numbers can be deceiving, as John said.
Yeah.
So you really want to dig deep and all that. Any final words?
Yeah, it's just something just caught my eye while I was scrolling. So I'm looking at this. They say they're in a way kind of like a service-based engineering kind of business. And as the basics of any financial statement, you will realize that it's either a very heavy COGS kind of business or heavy SG&A kind of business. So it just piqued my eye. I said engineering kind of company should be quite high SG&A. Now I look at SG&A, right? I'm like, huh? This just caught my eye out of the, while I was scrolling. 7 million for a business that generates about 316. Obviously, if you want to do a comparison, right, just pick up any engineering company and go and
But
7 is pretty low.
There's a chance that they actually park it in the cost of goods sold. It's project based, right?
Yes, maybe. Yes,
so
maybe.
if it's project based, right, they might
put it under COGS. Yes. So this one maybe just a HQ supports and all that.
So that's a very interesting insight because. This is my last point, the last point, right? The higher up the expenses on the P&L, the more flexible it is.
Correct.
So in that sense, if there was a good thing coming out of our analysis here is that when times are bad for Cypark, they'll be able to play around with their cost of goods sold.
Because you don't, let's just say if all this manpower is actually parked under COGS, right? project based, I don't pay EPF.
Correct, exactly,
I don't
exactly.
pay my SOCSO and all that kind
Right.
of. I only pay you for that duration
Correct.
of that project,
Yeah. So, one company that we like to shoot, and it's not really a company, it's called the government, right? So the government is well known to be, absorber of a lot of resources, and we know we have a deficit. Malaysia is in a budget deficit. So one of the reasons is because we have a bloated, what's the word? Emoluments, right?
Emoluments, yes.
Emoluments. So it's a bloated, workforce, government workforce.
Yeah.
And those are the kind of things you cannot change.
Yeah, it's
very
fixed.
difficult.
It's fixed
Exactly.
already.
Exactly.
So where
Emoluments
is
there, a quarter of
yeah,
expenses,
yeah,
right?
over here? Yeah.
So yeah, I think is that your last?
Yeah, I think that was my last. I actually it just caught my eye as I was scrolling. So hopefully you've learned something. In a way, this is basically how we would go about being thrown any company. What we find interesting is that, or what we find simplify over the years of us looking at all these numbers is that we all have a very precious resource, which is time.
Yep.
And what we try to do is within the first 5-10 minutes of doing what we call a desktop research, we can actually determine whether, hey, is this interesting enough for us to dig deeper?
Yep.
And rather than before you commit like 4-5 hours into a company, you do something of this nature, and then you can determine, is it up my circle of competence, my alley that I can understand it faster? And because in investing is really about making friends. I would like to simply making friends with the company. Not to say you have to fall in love with them. You can decide whether they should be your friend over the long term or the short term. Yeah. Just by doing something like this.
Yeah, well said.
Yeah.
So, guys, this is a new way of doing content, and we want to know whether this is something that you enjoy. And if you do enjoy, leave in the comments, right? So that we know what kind of content we can do that will excite you, right? And I guess signing off, and of course, remember, follow us on our Facebook, Instagram, our socials.
Like, comment, subscribe.
Share it with your friends, and we'll see you in the next video.